Are we in a broad-based contraction? Probably not. Likely not. And that is at odds with the Sahm Rule, because that was its whole point, was its purpose in life was supposed to be turn on early in a recession. It didn't do that. It appears, and yet that it is sending a warning signal about, like, the direction of travel is not good. And so it's just because it's overstating, I think, and some people disagree with me. That's fine. Like, it's hard to read these data to really know, like, are we really that close to the edge of a recession, or are we a good bit away from it? I don't think we're in a recession. I don't think we're right on the precipice. I think we're getting way too close for comfort. And frankly, it's, again, the lever of policy that is most likely to be pulled right now is reducing the federal funds rate, the Fed stepping in. It's unlikely we have fiscal policy as a support, and that lever generally takes some time to work. So time is of the essence right now. We have certainly had times, if you go back into the 1970s, where the U.S. labor force was growing and we still had recessions, right? So just because we've had a labor force increase, and it is true that when people come in or come back into the labor force and start looking for jobs, it can take them some time to find a job. And in particular with, say, immigration, there was a big change. We had labor shortages that were also pushing down the unemployment rate, complicate the Sahm Rule some, pushing down the unemployment rate, and then we swing from, bursts of immigration and, certain parts of the country, maybe there's more immigrants coming at one time, and so that can address labor shortages. That's very good. It also creates some adjustment issues, and an adjustment issue shows up in unemployment being a little bit higher. As long as those jobs catch up, then unemployment kind of comes back down, and it's not a cycle that feeds on itself. It's very hard to get a sense of how much of this is happening. It's not even just that the labor force is increasing, you're having different groups, it's the abruptness. Like, it just time. We've had a lot of very abrupt supply disruptions the last 4.5 years. This one happens to be in the labor market. What I have been trying to do, and others more broadly have been looking as well, is so, okay, well, the Sahm Rule, it's a number, 0.5 percentage point, the increase. And it's like, okay, well, what's usually happening in the U.S. labor market under the hood? Like, what's happening that gets us to 0.5 percentage point? One thing that I have been doing is looking at the different reasons for unemployment. So if you're, a new entrant to the labor market, like you've never worked before, or you're coming back, or you've been laid off temporarily, permanently, and just looking at, okay, what are those changes in the composition of the unemployed that get us across the goalpost of the Sahm Rule triggering, and then looking in different recessions, and frankly, it can be quite a mixed bag. It is unusual right now. There's more contribution, like the increase in the unemployment rate. There's a bigger contribution coming from these entrants, so into the labor force, than we've seen in recent recessions. But again, you go back to the 70s, and that was the case. So when I look at the components of what's driving, or like who are the unemployed that we're seeing, then I see it definitely raised some just kind of concerns with my approach, because I think there really is some of this supply in there that wouldn't necessarily be a recession. You don't want to have a false signal. You do have to also kind of think about, well, what are employers doing? And we know from other surveys that the rate of hiring has fallen back quite a bit as we've moved out of these labor shortages, kind of to like where they were in 2014, which the unemployment rate was quite a bit higher. It was not a good recovery labor market. And so if you're looking for a job, like, employers really just aren't hiring in the same extent, whereas they aren't laying off. So you can be like, well, then that's another reason that could be if companies haven't been burned by the labor shortages, laying off a bunch of people, having trouble hiring them back. Now they're maybe hoarding the labor. Like, they're being very cautious about laying off. Mm-hmm. And so then the margin, they're like, well, we don't have as much demand, so we just won't hire as much. So you have to be very careful. These are complicated patterns. So I see a lot of weakening labor demand. And again, we were running probably at an unsustainable demand because of the shortages, and like the economy was really cranking, have the higher inflation, and yet it's not shown signs of leveling out. Yeah, and that's a problem. And again, we have a policy lever that has not been pulled in terms of taking downward pressure off. Like, what do you expect? It'll keep weakening. We had, sadly, for almost 2 years, we were on recession watch in the United States constantly. In 2022, most of 2023, we had 2 quarters of GDP declines, which is the most famous recession indicator. And we had that, and there was no recession. You gotta go back to 1947 to find that. So again, we've broken a lot of our rules. And there was a lot of discussion, particularly as you went further into that, where the tech industry, and there were lots of layoffs, and you could see that in the California data, and you could see it with industry. But it also had this very specific, there was a lot of hiring during the pandemic, and then they're normalizing off of that, and then it's just an industry, so it didn't spread. Like those jobs lost were real jobs that were lost. That was a real dislocation. You could see it in the regional economy as well, and yet it didn't become a U.S. recession. And so it's always tricky with the industry, and the anecdotes is, do they start spreading? Consumer spending growth overall has slowed down, income growth has slowed. It's not that things are contracting, but they are slowing. And that's fine as long as we settle in, but it's the direction that's worrisome. And I'm much more concerned. I still don't have a baseline for a recession in, the coming months. I haven't had this whole cycle, but these are conditions much close, like the recession risks are elevated for kind of a broad-based weakness. And the Fed they are a data-driven institution. I think, frankly, they've been more kind of hyper data-driven. And it's like, we're not going to, we want more inflation data. Right, you can take it too far, and yet they're going to very carefully assess. And they know anyone who works in the space of kind of tracking the economy and thinking about downturns knows that things will start moving fast. I started my career as a forecaster at the Fed in 2008. That was when I learned how to forecast, was during the recession, the slow recovery. So you have to have a story, and it's important for the Fed to articulate their thinking and how they're reading the data. And then if the data come in, and they have healthy skepticism of the Sahm Rule as just a pattern, but they'll have also, is that labor market data, is that going to really persist? Is that they're going to want to and should, try to understand and definitely not overreact. And yet the Fed, they know this drill, right? There are times where they must, and they do shift. It's always nice to get ahead of things, but that's often not how it goes. There were good reasons, and even after we talked in February, the inflation data continued to disappoint. The forecast of where it was headed, what I had, this is where we are now, so I feel good about that, and yet I can understand why they felt the need to kind of slow it down a little bit in terms of getting going with cuts. It was a real missed opportunity last week to, they could have cut in July. It looked so like they had the crystal ball to do that last Wednesday, but they didn't. It's a missed opportunity. It's not their last opportunity. I think they'll have potentially some catch up to do, which isn't, the best way to do it, but I am worried about that. The lags are real. Yeah, because it takes time for the relief to get there, and I don't expect a lot of support coming from other parts. I wouldn't expect fiscal relief for Congress. I think Fed's kind of like, if we're going to level this out and get us, they're the game in town. And frankly, I think it underscores it was time to start letting off the brakes a little. The rise in unemployment absolutely is a concern. Not all of this is labor force participation. Not all of this is the kind of good kind of unemployment. And we have seen the unemployment rate move up multiple months in a row. Right? This is not a one-off. So, and it's the momentum that we have to, really guard against. So absolutely good news, likely not in a recession at the moment. If the Sahm Rule has failed and yet turned attention to a real problem that is brewing and helps us avoid, right? Like we should be having a conversation about what's happening in the labor market. It's not even just about the recession, right? A labor market that is firing on all cylinders is good for workers, and it's good for growth, it's good for productivity. So I get it, things needed to slow down to some extent, get back to normal. It's the idea of don't slow it down more than necessary. Again, inflation, we got inflation now. We can have low inflation and high growth. Like these two things do not have to contradict. If you have a productive, you've got a lot of, the investment, the workers have the background, they're matched up in the right kind of jobs. So we should be keeping this as good as it can stay. And so really any weakening at this point is weakening we should be concerned about and trying to back away from. The Fed has pointed in the right direction. They've already said they are in a place, they're going to start reducing interest rates. right? And I think, and the markets clearly think that that's where the Fed is headed. And I think the Fed will take a cue from markets and be pretty, really get at it. And that's what we needed, right? It took longer, I think, than it should have to get to this point. And yet we have an economy that is in a really good place. It just needs some pressure taken off it. And the Fed is aware of this. They have been, and I take them fully at their word. They understand and really appreciate the dual mandate. So not just the inflation and price stability, which is very important, but also the maximum employment, keeping the jobs. And they're at a stage, and they've said that very clearly, that they're going to balance those two. And unfortunately, the labor market need a little bit of help.